We're always told that profit is the ultimate sign of a healthy company. But what if I told you that a company could be posting record-breaking profits and still be just one step away from going completely broke? Today, we're pulling back the curtain on company finances to understand the crucial and often overlooked difference between profit and cash.
It just doesn't sound possible, right? You see the headlines, the company's reporting massive earnings, the stock's soaring, everything looks golden. And then, out of nowhere, it all comes crashing down. This isn't just a thought experiment. It really happens. And it leaves everyone scratching their heads, thinking, wait, how did we all miss that?
Well, the key to this whole puzzle is right there. It's the huge difference between what a company claims it earned on paper and the actual cold hard cash it has sitting in its bank account. Getting this distinction is everything if you want to understand what's really going on. So to crack this case, we're going to use the 3 essential tools of any financial detective: the balance sheet, the income statement, and, of course, the cash flow statement. When you put them all together, they tell the complete story. Let's start with our first clue. All right, our investigation starts right here with the balance sheet. Now, the best way to think about this is like a financial snapshot. It's a photo that captures a company's entire financial position, everything it owns and owes at one single moment in time, like on December 31st. And at the very heart of the snapshot is a simple but really powerful equation that always has to balance. Your assets have to equal your liabilities plus your stockholders' equity. It's just a rule. What you own has to equal what you owe to others, plus what the owners themselves have put in.
Okay, so what does that actually mean? Let's break it down. Assets are all the stuff the company owns: the cash in its account, the products on its shelves, the computers and machinery it uses. Liabilities, that's what it owes, things like bank loans or bills it hasn't paid yet. And equity? Well, that's what's left over for the owners. It's their piece of the pie if the company were to sell all its assets and pay off all its debts.
Now, this is a really, really important point. The balance sheet gives you the company's book value, which is based on old accounting rules and what things cost way back when. But a company's true value, its economic value, is its market value. That's what people are actually willing to pay for its stock today. A company can have a pretty low book value, but if investors think it's the next big thing, its market value could be through the roof.
So if the balance sheet was a snapshot, let's move on to our second piece of the puzzle, the income statement. And if the balance sheet is a photo, this is the movie. It doesn't just show you one moment, it tells you the story of how the company performed over a whole period of time, like an entire year. And the plot of this movie? It's actually super simple. You start with all the money the company made from sales. That's your revenue. You subtract all the costs of running the business, your expenses. And what you're left with, at the very end, is the famous bottom line, net income, or as most people call it, profit.
And boom, this brings us right back to the big question we started with. Seeing a big, healthy net income looks amazing, right? It's the number companies love to brag about. But if that number is so great, why isn't it the whole story? Why doesn't it stop a company from going under?
The reason profit can be so tricky is because of these things called non-cash items. Here's a perfect example: depreciation. Say a company buys a new machine for $1 million. The cash goes out the door on day one, but accounting rules make the company spread that $1 million expense out over many years. So every year, their profit goes down a little bit on paper, but no new cash is actually leaving the building. It's an accounting fiction, and it distorts the true picture.
And this, my friends, is where our final document swoops in to solve the whole puzzle, the statement of cash flows. This thing is beautiful because it ignores all that confusing accounting stuff. It only cares about one thing: how much real, actual cash came into the business and how much real, actual cash went out. That's it. And this really gets to the heart of it, doesn't it? Accounting profit can be shaped, molded, and sometimes distorted by different rules. But cash flow? That's the unfiltered truth. It's a direct look at the lifeblood of the company, the actual money flowing through its veins. There's a saying in finance: profit is an opinion, but cash is a fact. And it's so true. You need real cash to make payroll, to buy supplies, to invest in growth, to pay back your loans. You can't pay your employees with net income. You have to pay them with cash. That's why cash is and always will be king. And here's the wild part. A company can actually be reporting huge losses on its income statement and still be incredibly healthy because it's generating tons and tons of positive cash flow. Just think about Amazon in its early days. For years, it reported accounting losses because it was pouring every spare dollar back into growing the business, but its cash flow was solid.
Okay, so we've cracked the case of profit versus cash. Now let's shift gears a little and see how you can use this to think like a real investor and make way smarter decisions.
Let's take that same forward-looking thinking and apply it to something we all love, taxes. Most of us think about our average tax rate, the overall percentage we pay. But smart companies and smart investors focus on the marginal tax rate. That's the tax rate they'll have to pay on the very next dollar they earn. That's what really matters for future decisions. So let's put some real numbers on this. Imagine a company's average tax rate is, say, 30.6%. But they're considering a new project that's going to push them into a higher tax bracket. Well, the profit from that new project might get taxed at 39%. And that 39%, the marginal rate, is the number you have to use to figure out if the project is actually worth it. All right, let's boil this all down into a quick checklist you can use anytime you're looking at a company. First, and most importantly, is it generating positive cash flow? Forget the headlines about profit for a minute. What does the cash flow statement say? Second, is its market value bigger than its book value? Are investors optimistic about its future? And third, is it making smart, forward-looking decisions based on things like marginal tax rates?
At the end of the day, this is what it all comes down to. Learning to read these documents isn't just about becoming an accountant. It's about understanding the core economic logic of how a business actually survives, thrives, and creates real value in the world.
So from now on, when you see a headline about a company's record profits, you'll know to ask the better question. That's nice, but show me the cash. Now that you're in on the secret, which companies are you going to start looking at in a whole new light?